This is the Friday, March 6, 2020 version of the Market Plus segment. Joining us is Elaine Kub. Well, thanks for being with us, Elaine. Let's talk about coronavirus dominating the headlines again this week. And do we have anything else to compare this to, any other event like the financial sector crisis in 2008 or anything else?
Well, you know, I mean, really, the only really comparable thing is SARS in 2003, which didn't affect the commodities so much. And I only say it's comparable in that it was a virus, right? I mean, when you talk about an actual pandemic and the way that human beings respond to being scared and what economic activity they still go do and what they don't go do, what they don't go eat at a restaurant, they don't go to the movies, the conferences are canceled. All of these things cannot be regained.
Yeah, that's right. And we trade fear before fact in markets, don't we? So do you think we overreact, all this panic selling?
Well, some of it, certainly in the commodities. I mean, I think I made that clear on the show, is that some of these commodities are oversold based on that panic. But I'm also not somebody who's saying, oh, well, more people die of the flu than this coronavirus, we shouldn't worry about it. Because you will have people that try and poo-poo this, but no, it's real. I mean, when people are scared of this, it is a serious disease. People who have it generally need to be hospitalized. It is a higher death rate than influenza. It's a big deal. There's a reason why people are scared, and there's a reason why economic activity has fallen globally because of this coronavirus.
So some of the commodities that we didn't get to talk about during this show that were largely impacted: crude oil down 8.5% for the week, had its worst one day on Friday, down $4. And so that obviously has a big ripple effect into the commodities sector even, doesn't it?
Yeah, huge. So it's down to like $41 a barrel. And it should be. If you're talking about which commodities really legitimately should respond to this global economic shock, crude oil would be the one.
So how much farther do you think that has to go? Could
not even begin to guess. Yeah, I mean, I sort of thought it was going to bottom out there at $43 when there was sort of the feeling in the markets that things were going to be stabilized, but then it just kept falling, like you mentioned, on Friday, and I think it's couldn't even guess. I wouldn't want to reach in there and try and catch that.
Of course, some of that was OPEC had proposed limiting production, and Russia said they weren't going to go along with that, right?
Right. So, but I mean, we've known that for years now, that OPEC's power in the oil market has really diminished. Particularly, I mean, Russia's part of it, but the U.S. is the bigger story. That the U.S. is so dominant in its own, it's effectively virtually energy independent, right? I mean, we still have imports and we still have exports. There's still a trade-off there. But because OPEC is not as large of a player as it used to be for the entire global oil picture, they have limited power, especially if Russia's not going to play along.
So what impact does this have on the corn market or the ethanol market?
Ethanol prices will respond and trade in sympathy with that lower crude oil market, which isn't great for corn, but and we've seen sort of in the stocks, the ethanol stocks, the supply reports have not been super bullish for corn. So it's not a great scenario, but again, corn prices, futures-wise, have actually been fairly resilient through this.
So the cattle market, we've talked about that. If you took a S&P chart and a live cattle chart and stuck them over each other, obviously they would be tied together. Do we get any separation of the two, or does the cattle market just keep dropping with the stock market?
Well, long term, there is a correlation. Especially historically, I think that it has sort of fallen apart within the past several years. But long term, there is sort of a correlation, and certainly, like I mentioned, it's the historical trade that funds used to believe that cattle and the stock market move together, and they sometimes do. But we've seen it already now. The stock market had that boost back up because of the Fed interest rate cut, and cattle did not jump up in sympathy with the stock market boost this week. So I would say they're already sort of divorced, and there is no particular reason why an algorithm, let's say if it's the algorithmic computer traders that are in there doing this to the cattle futures right now, there's no particular reason why that algorithm has to call that a one-to-one everyday reaction.
So Chris from Nebraska wants to know that, can the cattle market rally independently from the stock market and turn around, or is it completely married to it?
I mean, I think that's what we've just been talking about. And I say, the cattle market was willing to keep on falling even when the stock market was bouncing back up. So what's to stop it from recovering if and when folks are really decided that the prices have gotten cheap enough that there are really good enough opportunities, and there are, in my opinion, to be buying these cattle.
So we have another question here on cattle from Dave from Ohio, and some people have speculated because of the re-entry of Brazilian cattle into the U.S. market. that it also affected the fat cattle price this week. Your thoughts on that?
Yeah, that's a legitimately bearish headline. Sure, yeah, sure. Great. I mean, but it's really hard to separate them. Like, this is not a pure science experiment where you have a control one day and only one thing trading the other day and only the other thing trading the next day. It's hard to say how much of any given day's losses in the cattle market were due to perceived demand destruction or due to intermarket arbitrage or due to the Brazilian entry. But it is a legitimately bearish factor.
So let's also talk about the dollar index, which obviously reacted to the Fed rate cut. And now I think we're trading below like 50, 100, and 200-day moving averages, Elaine, but it didn't help the commodity sector much on Friday.
Well, I think that's part of the reason why we've seen corn prices be more resilient than they have. But for soybeans, let me just point out that, we talked about the Brazilian currency being so weak and that being such a bearish pressure on global soybean prices. A lot of the times you'll see the Brazilian currency be so weak because the dollar is strong, that they're moving in tandem. But this week it was not. The dollar, as you mentioned, fell a lot, fell down, continues to fall, is in a downward trend because of the interest rate cut. But the Brazilian currencies and not all of, but most of the exterior currencies, foreign exchange trade was also lower. With Brazil, I think it's just a broader emerging markets trade, or certainly a Latin America trade, that the currency traders, the Forex traders, are really bearish on that region.
So the Argentina peso has also fell quite a bit to the U.S. dollar, right?
Basically nothing. It's, it's paper. They've got all kinds of problems in Argentina right now. We can talk about farmer strikes and anything, but yeah, those Latin American currencies have been very bearish for their own reasons, but to the degree that it affects U.S. soybean farmers, it is a hugely bearish influence on global soybean prices.
So the other impact of South America this week, not only did we have record production figures coming out from a lot of the private estimates, but we've got a little bit better weather scenario down there now, don't we?
Yeah, I mean, if you were going to go one way or the other, you'd be a little bit concerned about the dry weather for the late developing soybeans or for the second crop of stuff, but it's only in regional pockets, and by and large, I think you're right. We should call the South American weather generally favorable.
So the Argentina export tax, it's going to be increased from 30 to 33% on what, soybeans, meal, and oil now. So what impact is that going to have overall?
Well, I mean, I think stay tuned to see if it really happens. The farmers are really unhappy about that, and you've got a new administration there that is, in my opinion, sort of susceptible to public opinion right now. So I think stay tuned if that really gets enforced.
So the meal market was the leader last week, and it kind of fell back this week. Why was that?
I'm sorry, what was the question?
The meal market. Meal was the leader last week of the soybean complex, up 10.80 for the week. This week it kind of set back 50 cents, didn't do a whole lot. Was that meal oil spread unwinding? What was going on with that
market? It should always be the leader of the market, right? But we also need to consider that the global oils market has been an influence on soybean prices or global soybean prices for the past, I would say, 3-4 months. Since the Chinese African swine fever really had such an influence on their entire soybean crushing industry, and they started to turn to that Malaysian palm oil, and you got all kinds of oil prices get wild. So I don't think on any given week that we can say it's entirely due to meal prices or the meal gyrations in the futures market. You got to look at the whole picture.
Okay. We do have one question I want to pass along from James as well. If it happens that we have an early spring and fieldwork can begin early, how much pressure will that put on the grain markets?
I think the grain markets are not at all expecting at this point to have late planting. We don't see a price reaction. We don't see any bullishness in the new crop futures suggesting that the markets are already pricing in problems. The markets are assuming that everything is going to be okay. So I don't think that we would have a sudden collapse in new crop futures if everything does go okay. Let's just hope that everything does dry out for the next 8 weeks and we don't have a repeat of 2019. But I will say it's a real strong possibility we will, because if you look at the soil moisture profile, right now it's nice that the forecast is relatively dry for the Midwest, but the soil is still too wet, still too loaded with moisture from the fall. And I think that if I was going to guess one way or the other, I'd be guessing a late planting rather than an early planting.
And I have one last question about China. So we have import certificates are going to be issued now by the Chinese, and we're hoping for some business to come. Sorghum has been really the only buy that they've made so far. What do you make of all that?
Well, but also tariff exemptions for soybeans as well. So they've limited to certain companies. There is some tariff exemptions. So the prices, even like the business itself, but also the prices could be favorable for them buying soybeans. Buying sorghum is good. That was always great for the milo market a few years back when they were a big buyer of it. There's also rumors that they're going to be buying DDGs, also be great. But you know, that I think is less a signal of their overall need for feed grains than just a symptom of the weird supply chain problems that we have all over the globe. Ocean freight very cheap, their specific problems of getting feed trucked across the country. I think, yeah, all these rumors and ideas that they might be buying strange things or new things, it's really hard to make a broader trade off of that at this point.
All right. We appreciate your time, Elaine. Thanks so
Michelle.
much. And Elaine Kub, thank you so much for your insight. A reminder, many PBS stations are in fundraising mode. Please support your local station that carries market to market. You'll be investing in the news reporting and timely market analysis you trust. Join us again next week when we'll continue to explore the effect of coronavirus on the commodity markets. And Naomi Bloom and Matt Bennett will join us at the market to market table. Until then, thanks for watching, listening, or reading. I'm Michelle Ruck. Have yourself a great week.